Welcome back. You're tuned into the trading day. Let's welcome in Sacchitanand Uttekar, EVP for Technical Equity at Tradebulls. Sachit, strong, on at least some kind of a bounce back coming in, erasing all of those losses of trade yesterday. Of course, we've lost about 200, 250 odd points on the Nifty in the last 5 trading sessions. But really, is this just a short-term relief? What's the trend on the markets right now? What are the levels to be watching out for?
Well, yes, we have already corrected more than around 350 points right from the previous swing high that we saw, or lifetime high that we saw, and post that we've really not seen a kind of a reversal or a stability. In fact, this is today is one of the days wherein the volatility has just cooled off, and we are seeing some bouts of a bounce back coming back in the market. But from a levels perspective, I think the way the market breached below the 10,000 mark, and the way some of the stocks have participated, I think there is some room on the lower side which is still left. I think somewhere close to 9,740, 720 would be an ideal support zone from where the markets could again stabilize. So as of now, yes, we have stretched in the last 2 trading sessions, and we are seeing some stability here. This could be attributed towards it can be classified as a bounce back, but some firm reversal signs should be awaited, and key support level still rests somewhere close to 9740, 9720 zones.
Right. Let's talk about one of the stocks in focus right now. This is an MCX. They've gone ahead and tied up with Reuters for some of the commodity indices. But of course, there's a lot of talk about this stock because of the options trading that is coming in commodities. Also a bit of rejig as far as gold trading is concerned. Let's in fact hear out what the management had to say on some of the recent developments around the space, around the stock. Here's Mrigang Paranjape, the MD and CEO of MCX.
If you look at any institutional market and any institutional market that has developed, index is a product which is absolutely essential. Institutions would generally like to participate in markets where there are clearing corporations in place, where in terms of the product there's an index available to trade. So I think we are trying to make sure that all the building blocks that are needed for institutional participation are ready. We provide the data, we provide the back engine, we provide the basis, but the entire governance, the framework, which is absolutely essential in the creation as well as in the administration and the dissemination of an index, is all provided by Thomson Reuters, and volumes are definitely going to go up, and we are very hopeful that that will result in good increase of volumes over the years for MCX as well.
All right, so that's MCX for you, some of the movements over there. But Sachit, oil stocks have been in focus. Let's talk about an ONGC. That's the top gainer on the street today. This after Brent crude surged to a 2-year high. On the charts, how do you see ONGC? Do you see this move continuing here?
Well, absolutely, yes. The way the entire trend is shaping up here, the way it has oscillated within the band of 160, 165, the way we have seen the consolidation and the breakout which we have seen today, I think there's still further room, on an immediate basis. We expect the stock to scale higher towards 176. If you look at the overall trend formation, we are witnessing accumulation kind of a zone, and we are expecting that in the coming months we may see a firm trend reversal from this particular point of time. So on an immediate basis we expect this particular momentum to continue right up to 176, 177, and I wouldn't be surprised if in the coming months we see this particular stock scaling above 190 levels.
190 levels, that's where an ONGC could head next. Let's also welcome in Avinash Gorakhsakar, Head of Research at Joinder Capital Services, to get his sense on the markets. Avinash, talk us through your reading of the market. Last couple of days it's been a big drop, and then now some kind of a recovery coming in today. As far as the indicator goes, where do you see the markets heading right now?
No, I think clearly, I think in the near term, 10,000 now seems to be a stiff resistance. And on the downside, I think, today the market seemed to have given a good, healthy bounce back, which was more or less on expected lines after a very sharp pull down. I think this was on anticipated lines. But I think what is very important is the markets would now like to know clearly on the macro side what kind of numbers would pan out, because the GST impact and the demonetization impact has actually hurt industry quite significantly, and our sense is that now corporate earnings are yet to take a little more longer to actually give a kicker to the markets. I think it's going to be a selective market where possibly good valuations would obviously drive share prices. But yes, I think the pace of increase of most of the stock prices now would be very gradual. So I think it's not that the markets would not definitely go up, but yeah, liquidity is yet coming in from the domestic mutual funds, which is a good sign. But at the end of the day, I think the risk reward would definitely pan out if valuations become a little more attractive. So I think it's going to be a buy on decline market, but yes, with a slightly longer term horizon.
It remains a buy on decline market, but you need to keep a slightly longer term horizon. The liquidity part, Avinash, that's a little interesting because mutual funds are sitting on cash despite all the deployment by domestic institutional investors. Mutual funds still have a large amount that they're holding in cash. The average SIP amount has now touched about 5,000 to a little more than 5,000 crore rupees per month. So say what you may of the markets and whether there are limited avenues to invest in or not, there is a lot of money on the sidelines still just waiting to enter.
No, exactly. I think, your point is very valid that liquidity will definitely come in the markets, and I think equity will continue to be the best asset class. There's no doubt about it. But clearly with the stock, most of the markets, having gone also up in a very short time, I think obviously fund managers have now a big challenge as to how they deploy this money on a regular, on a monthly basis. They have to do it because they can't keep their money idle. I would believe that, I think it's going to be a mix of large cap and, mid caps, but I think the frontline large caps would now take the action more, because in mid caps you have seen the prices going up quite significantly. Some major price corrections have happened. So I think probably in the near term large caps would provide a room of comfort for most of the funds.
Large cap would provide room of comfort for most of the funds. So that's where you should be looking at. Let's talk about one stock that's given good returns in the short while that it's been listed, and this is an Avenue Supermarts that we are talking about. Gains of almost 10% right now. So it's cooled off from the highs of the day, went up by about almost as much as 15% at one point, still holding on to gains of about 10% right now. Goldman Sachs extremely bullish on this counter. A target of 1586, which was at a premium of about 50% from yesterday's closing price. So a significant jump is expected over here. Let's get in Piyush to give us more details of Goldman's report.
Well, the target price is still more than 30% from the current market price. They actually have initiated with buy rating target of 1586, and that again is a whopping more than 30% upside is what actually they are saying. Not only this, actually the strength of their conviction actually comes that they have added the stock to their conviction list. They say that the company basically returns on invested capital, it remains better than most of the global retail peers, and again what they are saying that it has actually the most upside in their coverage universe. All in all, a very bullish view. Now let's also see what are the arguments here. The first argument is what they're saying is they're expecting 13% average growth in sales per square feet over the next 3 years. Again, 13% is actually very high, but also they're saying that sales per square feet is already 50% higher than the next competitor. So again, their basically bullishness comes from the fact that DMart again continues to remain very focused on low prices, cost efficiency, and also increasing the wallet share of the customer. What the next actually is they're saying that because of GST transition, GST implementation, the organized market share, the organized share in the entire grocery business, in the business which actually DMart operates in, is actually going to increase significantly. The estimate is that the market share is going to increase to 79% by FY20 from just 4% in FY17, and that's why they believe 33% average sales growth is going to happen over the next 3 years, and then 26% over FY20 to FY23, which means overall average the sales growth would be somewhere around 30% for the next 5 to 6 years at least. And again what they're saying is that also Avenue Supermart, they actually are pursuing a strategy of building more pickup points, which actually is going to enable more home delivery for an additional fee. So perhaps some more value added offering also, by which the margins again will see uptick, but broadly broadly, if I combine and if I conclude with two arguments here, one is explicit increase in the organized market share, and DMart being the cost leader is actually slated to benefit from it. And number two is that sales per square feet is going to actually expand rapidly, very highly. That's where the entire optimism is coming for Goldman Sachs.
Right. Thanks for that, Piyush. But before I talk to my experts on Avenue Supermarts, just pull up ONGC again. We were just talking about this stock. This has spiked almost 4% on the back of that big spike that you've seen in global oil prices. Crude oil continues to spike, which also means that deregulated fuel prices in India will heat up further, worsening the public outrage over the issue. BTVI learns that the government may now have to review the excise duty on fuel to erase the burden on the common man. Our executive editor Siddharth Zarabi on the phone line with exclusive details on this. Siddharth, the big question then, are there any indications that the centre may relook at the current excise duties on petrol and diesel to ease the burden?
Well, that's a very good question, and I would say not $1 million, but $1 billion question, Dipanshu, because the maths is what is important at this stage. We are not saying that the centre is moving to sort of take a fresh look at excise duties on fuel, either with an upward bias or a downward bias. That is not the point that we are making in this story right now. What we are pointing out for our viewers is that as far as the government of India's own internal assumptions with regard to the crude oil price that it pays through the Indian basket, as well as the exchange rate, both two crucial determinants in the overall fiscal calculation and the arithmetic of the government, the one single fact that stands out right now, despite the international crude oil spike and the upward trend, is the following. The government of India had assumed for the balance part of FY18, which includes the month of August up till March 2018, per barrel cost of $55 at an exchange rate of 65. Now, what is the existing reality? The Indian basket crude, as of July of this year, the average price was $50.63 per barrel versus 47.86 in July. The August average was 50.63 versus 47.86, showing a month-on-month increase in absolute terms of almost $3 per barrel increase. As of September 22nd, the Indian basket price per barrel is $55.77 at an exchange rate of 64.96. What I'm trying to therefore establish here is that the two benchmarks for the fiscal arithmetic and therefore the decisions on excise duty structure are, one of them has been more or less breached, which is the exchange rate, but the per barrel price, there is still headroom of $5 per barrel, but that is an average for the remaining part of the year. What is now happening in global crude oil prices will feed into the Indian basket and will therefore influence the total outgo, which we know as far as FY18 is concerned, the crude import bill is pegged at $81 billion, a 16% increase over the previous year's number of $70 billion. So the key point here to note is that the exchange rate tolerance has been breached, but there is still some headroom, 10% headroom as far as the per barrel crude price is concerned.
Right, so the exchange rate headroom has been breached, but there is still some room on the crude price assumption. Very quickly, Siddharth, if in case the government does need to tinker with duties or possibly look at some kind of a relief measure over here, do they have the headroom to do that? We know the finance minister is holding a press conference today evening to update us on August GST collections, but GST revenue collections at least so far have been a little soft. So can the centre, if at all, afford an excise duty cut right now?
Well, you know, petrol excise and diesel excise. Petrol was raised 127% from May 2014 till January of 2016, and similarly, diesel excise went up close to 390% in the same period. Since then, we have not had any adjustments on excise duties as far as fuel is concerned. There are two simple ways to look at this. If GST collections are buoyant, there will be some headroom, some elbow room that will can be created as far as reducing the daily price increase burden. I think one of the biggest reasons for the consumer level anger or outrage has been the daily price policy that has been brought in select territories of the country, and that is in fact feeding into public anger. The second point really would be the overall price movements for crude as well as the exchange rate. I suspect that the government will hold on to a decision on this till there is greater clarity and stability as far as month-on-month GST revenues are concerned, and perhaps it will take into account the overall future scenario for at least 1 quarter as far as the crude oil basket price is concerned. So, in conclusion, Deep, just to say that we cannot conclusively say that excise duties will be revised either upwards or downwards. What we can say at this stage is that of the 2 or 3 crucial determinants, one of them is close to a level where the government will be forced to relook basis its assumption for a $55 per barrel price for the remaining part of the financial year.
Absolutely, Siddharth. Thanks so much for putting that news in perspective for us. So you may not see any tinkering on the duty structure as yet, but clearly reaching close to trouble levels as far as the headroom on the exchange rate is concerned, and near that level or just about 10% away from that as far as the headroom on the crude price assumptions is concerned. So this is going to add to headaches for the government. You are waiting for the finance minister's press conference later today evening to update us on August GST collections. But Avinash, just a word on ONGC sitting near the highs of the day right now, 4.5% uptick coming in. If this move up in crude oil continues, are we looking at a better scenario for ONGC?
Yeah, I think definitely rising crude prices would obviously have a positive impact on ONGC, and I think for a very long time, the ONGC stock actually suffered from an overhang of lower crude prices plus the hangover of possibly FPO which was expected from a long time. So I think clearly if crude prices do continue to inch up further, I think you could expect some better numbers at least from the 3rd and 4th quarter of this fiscal. And I think clearly on the other side, oil marketing companies could find it a little tough, because on one hand, rising crude prices plus the weakening rupee would obviously mean that their margins could come under pressure for a few quarters.
All right, let's take a very short break. Don't go anywhere. We will be back with a lot more on the other side. Talk about Avenue Supermarts with both our experts. Also play out some exclusive comments from market guru Saurav Mukherjee of Ambit Capital on where you should invest your money in a market like this.
If this device can surf, download, play games and videos, then you'd say, what's new? But what if this can do all that and more? Well, here's the Wi-Fi enabled Airtel Internet TV. Full play.
Welcome back. You're tuned into the trading day. Before the break, we were talking about Avenue Supermarts or DMart with our experts. Sachit, you take the lead on this one. 10% up move on a chart that's already just run up since listing right now. Purely in technical terms, I mean, does it make sense to go ahead and buy this one right now?
Well, as you rightly said, since the day this particular stock was listed, we have already seen a good secular up move in this particular stock. In fact, it has been outperforming even the index. So if you look at, today's price action, yes, we have already seen a good strong jump in volumes, and even the price action has been very much positive. But if you look at the entire structure since May, this entire move, you can really check it on the daily scale that this entire up move has been within the channel formation, and right now the stock is again sitting right at the upper end of the channel. So I would rather wait for some more consolidation to take place rather than just jumping into the counter as it is trading near the higher side of this particular pattern. So one should really wait out 1150, 1155 on a closing basis, and then probably one can say that the pattern has witnessed a breakout, and we may see a follow through movement right up to say 1290, 1280 kind of a level. But as of now, I would really wait out for this particular closing to take place, and then probably some more consolidation. That will give a better picture rather than just jumping into the counter at this point of time.
Avinash, what would you do with this stock? I mean, if you go through the details of the Goldman Sachs reports, they've taken a lot of long-term calculations to arrive at a target price for today. How do you deal with a stock like Avenue right now?
No, I think clearly, I think if you look at the valuations based on next 2 years estimates, I think it definitely does not look cheap in any case. But obviously, the Goldman Sachs reports has obviously taken a kind of a discounted cash flow kind of valuation metric, and taken FY29 as a kind of year of termination, and then worked out on this value. I think in a very short summary, I would only say that the liquidity in this stock is extremely limited. Hardly about 15% stock is available with the Indian public, and I think probably at these valuations, the risk reward clearly in the near term looks a bit challenging. I think we have seen stocks like Shoppers Stop, or for that reason Future Retail. These are stocks which have actually also rallied. So the overall flavor in the retail market has gone up quite significantly. My sense is I think this is a stock to be held on for the next say 3-4 years. But to buy at this price and to assume that in the next 12 months one could get a decent risk reward ratio, that would be a little too much to expect. So I would say that long term prospects are good, but yes, valuations are definitely not cheap either.
So don't expect stellar returns from an Avenue, not in the short term or in fact on a 1-year time horizon. But if you can hold it for longer than that, maybe a 5-year view, then definitely this is something that you should have in your portfolio. What else should you buy in a market like this, which is seeing a bit of volatility, a bit of concern on the macro front, and private investment lacking? That's the question that we put forward to our market guru of the day, Saurabh Mukherjee of Ambit Capital. Here's what he had to say.
I think every 5-year cycle, every 5-year election cycle in India follows this pattern, wherein the first 2 to 3 years are reasonably tight fiscally. Governments tend to behave themselves for the first 2 to 3 years after a general election, and then inevitably the 18-month run-up to a general election, where you also have a whole flurry of state elections. I think we've got 13 assembly elections before the general election. So in a 16-month window, you have 13 assembly elections and the general election. So it is but natural that in the sort of slog overs of a 5-year election cycle, you get elements of populism in the final 14-15 months of a 5-year cycle. I think we will get that. I think what makes it that much more likely that we will get elements of populism is the economy clearly is in trouble. The economy is stagnating. The job creation picture is probably grimmer than it's been in the last 10-15 years. So that obviously will add to the tendency to increase populist spends. That being said, it's not apparent to me that there is that much fiscal headroom for populist spending. I think both on direct and indirect taxes, the collection picture is reasonably opaque, reasonably unclear, and therefore I think the populism will be checked by the lack of visibility on revenue receipts on the fiscal front.
Exactly. That's the point I was trying to come to. The populist measures are quite common, during the last lap of the current rule. But unfortunately, it's coinciding with all the key big drivers disappearing from the scene for now. As you pointed out, economic growth has taken a knock. Stimulus is kind of all talk and no money. Rate cut possibility from RBI looks dim. And above all, most importantly, maybe the liquidity pipe could start drying gradually. How do you view this?
I think what you're saying is all true. I think it's been true for a long time now, 5 years almost, that our capex cycle has been dead. Exports also died as a source of growth 5-6 years ago. So we've largely been running on domestic consumption. Consumption has been the one element of our economy which has driven growth. But even on the consumption front, due to the weakness on the jobs front, I think we're seeing a degree of slowdown there as well. And I think retail credit quality, I think looks likely to worsen. Retail credit quality weakened in the first quarter. I think it will weaken further. That being said, I think where there are elements of where there should be grounds for optimism is we have a world-class IT services sector, a world-class pharma sector. Because of relentless pessimism in the stock market, both of those sectors are beaten down. And I think both in IT and pharma, there are companies which are worth investing in at these valuations. Similarly, more generally in the Indian stock market, the only long-term method of investing which works in India is buy high-quality companies and sit on them for long periods of time. And as the market corrects over the next 3-4 months, I think that we will have entry-level opportunities in high-quality names. So it's a good stock market with high-quality names. I think a significant correction will give investors reason to buy these high-quality names. So I'm not that pessimistic about the market. I think a correction in the stock market, which I think is long overdue, a correction in the stock market will give the discerning investor room to buy high-quality names. And in that regard, greater macro pessimism, which leads to a market correction, I think bring it on. I think it will be good for the discerning investor.
Good for the discerning investor. Look to buy quality. That seems to be the consensus all around, and don't get too worried about the dip that's happening in the market right now. Use that as an opportunity. Back in just about those flat to negative zones on the Nifty right now, but it has been a reversal at least as far as the trend of the last 5 days is concerned, especially of the last 2 trading sessions on the markets. But it's just about 10 minutes to close. Sachit, let's get some trading ideas from you, either BTST or STBT calls. Which are some of the stocks on your radar right now?
Well, I have 2 stocks which are kind of a BTST, STBT kind of zone. If you look at VDL, the way this particular stock has reacted from the lows around 300, we expect the momentum to continue right up to 325. Stop loss can be placed at around 311.8. And the second call would be a short call on Kotak Bank. If you look at the overall formation, we have already seen that this particular stock has been under pressure. We expect the lower levels around 975 to be seen. Stop loss can be placed around 999.
All right, so those are some of the trade calls from Sachit. Avinash, what are you doing with banks? I was reading an Edelweiss report this morning on ICICI Bank. Measures are underway to possibly rationalize their NIMs, also looking at some kind of balance sheet cleanup process. Of course, pain may continue for next couple of quarters, but is ICICI at around 277 odd a good value buy?
Yeah, I think if you look at the way asset quality has panned out, and I think the kind of write-downs which they've already done, I would believe that this is definitely a good entry-level price if one were to take a slightly longer-term view, say 12 to 18 months, because I think most of the pain is out of the system. Maybe for a quarter or two, some pressure on the NIMs may come in, but they have made a decent kind of effort to actually write down most of the bad assets upfront, and clearly looking at the kind of loan book growth, especially from the retail side, ICICI Lombard issue now getting listed tomorrow. So obviously some more kind of triggers in the near term could be visible on the ICICI Bank stock. And I think yes, if you compare this with Axis Bank or some of the other larger banks, I would say that this is definitely having a very solid retail franchise and a decent balance sheet. So I would believe that if somebody has a long term view, one should start nimbling at the current odd levels.
All right, so that's ICICI Bank for you. Sachit, any interest in an ICICI Bank on the charts for you?
Well, we have seen a decent bounce back in today's session. In fact, the stock is quoting at its 200-day exponential moving average. But this is not a good enough evidence for a reversal as of now. We need a decisive closing about 285 on a consecutive basis, and then probably we may say that the ongoing correction has been over, and the stock may resume its uptrend. But as of now, I think there is pressure on the private banking names, and we expect some kind of a stability coming in to this counter somewhere close to 270. So probably one should wait out for lower levels to create fresh long positions as far as ICICI Bank is concerned.
All right, Sachin, let's also talk about a couple of Tata Group stocks. And I mean, we continue to talk about this, but there's always some trader interest or the other. Tata Global and Tata Coffee. Tata Global, especially after a few days of consolidation from that strong up move, it started to move again. It's gone up by about 4% today, reclaimed the 200 rupee mark. How do you see this one panning out on the charts?
Well, 190 is the critical support from here on. So far as this particular support is held, the trajectory continues to be on the positive side. In case if we see a closing below 190, then probably there's a fresh correction which could be witnessed right up to 175, 180 kind of a zone. But as of now, I think the mood is set. The trend has been right, and 190 remains a strong support for this particular counter.
Avinash, two-wheeler space. Honda has taken the lead as far as scooter sales are concerned. You have TVS, whose scooter portfolio is doing very well. Hero Moto continues to chug along. Bajaj Auto does not have any presence in scooter. They're trying their premium bike. It hasn't really shown a result so far. If you were trading these four stocks, which one would you, or these three stocks, sorry, and maybe let's add Eicher to that list. Which one would you bet on? There was a UBS note in the morning where they've upgraded Hero and increased the target on that. Is that something you would go with, or would you go with TVS or Bajaj?
See, I think clearly within the two-wheeler space, I think Hero MotoCorp and TVS look well positioned because their product mix is very optimal. I think margins have also improved, and I would believe that as far as Hero MotoCorp is concerned, the good monsoons is obviously going to drive the rural push for Hero MotoCorp. TVS Motor also definitely looks quite good since they have a decent exposure in the scooter kind of segment. So I would believe that two-wheeler space definitely would see a lot of action from these two players. Bajaj Auto, I think the real trigger for Bajaj Auto could come in once their tie-up with Triumph actually takes off, and we see those bikes off the road, because that is going to be a near-term trigger. I think the company has clearly said that they are looking at heavier bikes to actually compete with Eicher's product portfolio, and obviously with a very long waiting list for Eicher Motors Royal Enfield bike, I think there is definitely a space in this market for a new player, provided the model and the performance of these bikes actually takes off. So Bajaj Auto could be a distant third, but probably once the product comes in the market, and we could see some more action there.
All right, so Bajaj could be a distant third, but for now the action remains with Hero as well as a TVS. Incidentally, UBS is very bullish on a Hero. They have a target of 4750 on that counter, so another about 1,000 odd rupees from here. And they've upgraded it to a buy, double-digit volume growth to drive re-rating. And they are expecting FY18 two-wheeler sales growth forecast of about 12% so that should be something that will drive Hero Moto forward. Not too much of a reaction of that report coming in on the stock, at least in today's trading session, just about holding on with gains of 0.7%. Any pharma picks that you like, Avinash, from the mid-cap space, from the larger names? You saw some move that's happened in Divi's, Natco, Ajanta, or would you go with the larger names?
No, I think within the pharma pack, we have been recommending Aurobindo and Natco Pharma. In fact, Aurobindo Pharma, we believe that looking at the kind of business model and the kind of less regulatory impact on their business, they would also have a decent exposure on the US markets. But obviously, compared to a Sun or maybe a Lupin, they are definitely less impacted. So Aurobindo Pharma definitely from a 12 to 18 month horizon can give a decent risk reward. And Natco Pharma, again from the current year's kind of management commentary plus the Q1 numbers, I would believe that FY19 is going to be a trigger year where a lot of molecules are going to be realized in material terms, and we could see a big trigger happening that time. So probably Natco Pharma could be for those guys who want to take a slightly longer term call, but Aurobindo could possibly return 15-16% over the next say 12-15 months.
Aurobindo can give you 15-16% over the next 12-15 months. Natco, if you are looking at a slightly longer term horizon. But Avinash, thanks so much for joining in today and taking us through your reading of the market. Just about 2.5 minutes to go before we wind down for trade today. It's been a steady day after those bit of a volatile moves, but you've again moved back a bit into negative territory. So at around about 98.50 right now on the Nifty is where you are at. You've seen metal stocks that have been action. You've seen a couple of pharma names that have done well, and a couple of banking stocks as well, especially the likes of an Axis as well as an ICICI. But apart from that, the market breadth continues to remain weak. So as both the experts have pointed out, don't read too much into this sudden reversal of the downtrend of the last 5 days. Maybe this is a short-term relief, but of course there are key levels that you should be watching out for. Sachit, just before we get into closing, a couple of stocks for you. Eros International, there's a 10% jump that's come in on this one. And Godfrey Phillips, along with some of the other tobacco stocks, up about 7.5% in trade right now. How do you see these two names?
Well, Eros, on the weekly scale, it has been oscillating within a downward sloping channel. 230, 235 has been a decent resistance for the stock. So I think the move that we have seen right now, once we have a closing about 235, then probably we may see an extension of this particular move right up to 270. But I think the way the momentum has been building up, I think it is safer to comment that 230, 235 could be a resistance at least for next couple of days. On the lower side, I think the support now is somewhere close to 200 from a trading perspective, and in case if this particular level is breached, we may again see this particular counter oscillating back to the lower end of the channel, placed somewhere around close to 175. But as of now, I think the momentum which has been built up, the stock may rally towards 235.
All right, may rally towards 235. That's the view on an Eros. Let's close on trade today then. It's been a bit of a volatile day, and this is expected because this is expiry week. But on the Nifty, again moving back into negative, back to about those 98.50 levels. You did go down to about 98.20 at one point in trade, and you were in danger of losing possibly the 9800 mark. But since then, you did reverse course, down about 0.2% at close of trade today. Broader markets have also attempted some kind of a pullback today. So the small cap index especially up about 1% at close, mid cap up about 0.3%. Some of the metal names have been in focus. Vedanta up 3.5% at close. Tata Steel and Hindalco have also done well. You saw a good move come in for the likes of ONGC. This after Brent surges to a 2-year high. Indiabulls Housing Finance has bounced back today in line with some of the other NBFCs, especially a Diwan Housing Finance from the mid-cap space that saw good gains in trade today. We'll talk more about that. Axis Bank and ICICI Bank from Bank Nifty have been positive. You've also seen some move come in for something like Coal India and Infosys. Aurobindo Pharma also up by about 0.5% at close of trade today. But again, on the weak side, you have OMCs that are under pressure. This again on the back of crude price jump. So BPCL, IOC, HPCL, all three of them were weak in trade today. Bharti Infratel was down 3.5%. Tata Power was down about 2.5%. HUL was down 2.5%. Asian Paints, Dr. Reddy's, TCS, Tech Mahindra, Bharti Airtel. Some of your key large caps were under pressure in trade today, and that's weighed down on the index as well. From the broader markets, some of the mid-cap pharma names had a good day of trade again today. Wockhardt especially 4.5% up move coming in on that one. Torrent Pharma was up about 2% as well. Tata Global bouncing back up 4% in trade today. Bharat Forge had a good day of trade. Indian Hotels did well. Jindal Steel did well. Alchem Laboratories, Page Industries, Reliance Infra, Adani Enterprises, SJVN, Whirlpool and Blue Dart were some of the other counters that were in focus. Some of the other mid-cap names, Eros and Godfrey Phillips that we just spoke about. Edelweiss Capital did well. Phoenix Mills was up 6.5%. VRL Logistics was up about 6%. Kaplan Point, Prestige Estates, Oil India, VIP Industries, Thomas Cook, Trident, Aban Offshore. Incidentally, some of your drilling and offshore companies did well in trade today. So Aban Offshore, Dolphin Offshore were both in focus this morning. Pull up a Ceylon Offshore as well. Let's see, Ceylon Exploration, let's see if there was any move in that counter as well. But these stocks were also buzzing in trade today. Stocks that fell, Future Consumer incidentally was up about 4.5% as well. Stocks on the broader network that fell, TV today, this one ran up by almost 15% in trade yesterday, erasing all of those gains today, down about 10% at close. Bombay Dyeing was down 5%, Central Bank was down about 6.5%, HFCL, JP Associates Shipping Corporation of India, which saw a strong gain in trade yesterday, down about 4% today. Baltic Dry Index is around a 3-year high. REC was down about 4%. Blue Star was weak. Jet Airways, 8K Miles, DCM Shriram, Bata and Dabur were some of the other weaker pockets in today's trading session. But Sachit, this is the expiry week, just about 2 sessions before the September series expire. So if there is a short-term level that you can talk to us on the Nifty that the traders should be watching out for, and your view on the October series.
Well, the way we have seen last 2 trading sessions on a closing basis, if you look at the candlestick pattern itself, we have 2 bearish belt hold formations, one at 10,100 and the other one that we saw yesterday around 9960. So these are the critical levels so far as the upper bounds are concerned. And on the lower side, we are yet to see a firm reversal, and I think 9740, 9720 could be a decent support zone going forward. So if you look at from an expiry perspective, we still have 2 trading sessions, and an expiry somewhere close to 9930 on the higher side, or else somewhere close to 9800. This is the probable levels that we are working for. We are working with. But if you look at the October series, then purely 9700 looks like a decent support. But on the higher side, I think 10,100 would be a critical level. So overall, the range on the broader side stays at 10,100 on the higher side and 9,700 on the lower side.
10,100 on the higher side, 9,700 on the lower side. That's the range that you should be watching out for on the market. Thanks for joining us this afternoon, Sachit. So that's the market action in trade for you today. Absolutely flat. That's where you're closing at this after you fell about 50 odd points or about 0.5% at one point in trade. So there was a recovery that happened. Whether this